We are jumping straight into Sky Quarry today. And for anyone watching the market, the price action has been just, well, dramatic.
Dramatic is putting it lightly.
Right. We're talking about a stock that's dropped 30% recently. That's on top of a massive, 81% loss just this year?
Yeah, and that kind of plunge, it usually tells a pretty simple story, a story of failure.
But that's why we're here. The simple story is almost never the whole story.
Exactly. What we have here is, it's a classic battle. You have this company with genuinely disruptive proprietary recycling technology on one side.
Okay.
And on the other, you have just crippling short-term financial distress. It's a clash between an incredible tech moat and a very, very stressed balance sheet.
And there's this wild card, $100 million digital asset strategy they're pinning their hopes on.
That's the potential game changer. So if you want to understand the why behind these huge market moves, you are in the right place. We dig into the details to help you cut through the noise.
We're glad you're with us. And if you're finding this useful, do us a favor and hit that subscribe and like button. It really helps us bring more analyses like this to you.
And drop a comment. Let us know which company you want us to look at next.
All right, let's start with the foundation. The bull case for Sky Quarry. What's the good news here?
Okay, so the bull case is all about their core business. This is not just another oil producer.
Yeah.
Far from it.
Let's get into that core tech then. They're not just, pumping crude.
No. They have a proprietary closed-loop extraction technology. And what it does is it takes this huge environmental problem waste asphalt shingles, and it turns them back into usable resources.
Which is a massive problem. I mean, the scale of it is staggering.
It is. In the U.S. alone, we're talking about 15 million tons of these shingles getting dumped in landfills every single year. It's a crisis.
And Sky Quarry's tech, essentially. It just eats that waste.
It eats the waste, exactly.
Yeah.
And if you process that 15 million tons, that's the equivalent of somewhere between 20 and 22 million barrels of recoverable oil. So this isn't just about cleaning up landfills, which is great from an ESG perspective. It's about unlocking real economic value from something everyone else just buries.
So how does the process work? What makes it so unique, this IP?
The magic is in the clean separation. So you take these old, dirty roof shingles, which are basically just solid tar, right? You run them through their system, and it cleanly distills out a high-quality synthetic crude oil. And the best part is, what's left behind are clean aggregates that can be reused in construction.
So it's a true closed loop, waste to oil and waste to aggregate. Nothing goes to the landfill.
Precisely. And they've integrated this IP with their physical assets. They own the Foreland refinery, which can process 5,000 barrels a day, and they've got leases on nearly 6,000 acres of bitumen in Utah.
So they control the whole chain.
The entire chain, from sourcing the waste to refining the final product. That creates, incredibly high switching costs for any competitor. They have the secret sauce and the kitchen.
Okay, that is a powerful moat. But we have to talk about the flip side, the balance sheet. Because despite this incredible tech, revenue fell off a cliff last year.
And that's the big headwind. Last year was brutal. Revenue dropped somewhere between 47 and 51%. That's a huge red flag for the market. It screams execution risk.
It's a massive decline. Is there anything in their history that suggests they can actually scale this thing?
There is, actually. If you look back over 3 years, their growth was 101%. So that shows the model can scale when the conditions are right. They just proved it again in Q1 with over $6 million in revenue from a mix of asphalt, diesel, and other products.
So the product is viable. The problem is the speed of the ramp up.
The speed and the cost.
Yeah.
It brings us to the thing the market is obsessed with right now, cash flow.
Negative free cash flow, right? FCF?
That's it. Their free cash flow is negative because they're pouring every dollar they have huge capital expenditure, or CapEx, into getting that Foreland refinery up to full capacity.
They're building for the future, but they're burning cash to do it.
Exactly. And when you're burning cash and your revenue is dropping, that creates a funding gap that makes investors extremely nervous.
And that nervousness leads directly to things like NASDAQ compliance issues, doesn't it?
Precisely. The selling pressure pushes the stock price down, and if it stays below $1 for too long, they risk getting delisted. The market price is at risk in very, very quickly.
Okay, so with that huge price drop, the valuation must be pretty low. I'm seeing a price-to-sales ratio of around 0.4 or 0.5.
Yeah, which for this sector, and especially for a company with this kind of proprietary tech, is, well, some would say it's deeply undervalued.
Yeah.
That 30% plunge we talked about, it has all the hallmarks of a capitulation bottom.
Meaning everyone who's going to panic and sell has already sold.
Potentially. It suggests the worst of the bad news might already be baked into the price.
But they still need to fund the growth. So how do they do that without just crushing existing shareholders with more dilution?
That is the $1 million, or I guess $100 million question. I mean, we just saw them settle a debt for nearly $500,000 by issuing 1.47 million new shares.
Okay, that sounds pretty technical. What does that actually mean for an
Right.
investor?
It's basically a trade-off. They get rid of debt without spending cash, which they desperately need. But the downside is that it's dilutive.
Meaning my slice of the pie just got smaller.
That's the perfect way to think about it. The company pie is now cut into more slices. So even if the pie itself doesn't shrink, your piece does. And the market hates repeated dilution.
Which brings us to the big catalyst, this digital asset strategy.
This is their plan to get out of that dilution trap. They're trying to raise $100 million through what's called a real-world asset, or RWA, tokenization strategy.
Tokenization is a huge buzzword. For anyone who isn't familiar, what does that actually mean for a refinery?
In simple terms, you take a real physical asset, like their refined oil or their rights to the bitumen leases, and you represent ownership of it with digital tokens on a blockchain. They're doing this with a partner called Continuum, and it creates a way for investors to finance the company by buying tokens that are backed by real, tangible things.
So it's like a loan, but instead of going to a bank, they're raising it from the crypto world, collateralized by their oil.
You've got it. It functions as non-dilutive financing. It lets them raise that critical CapEx money without issuing more stock and shrinking everyone's ownership stake.
Hold on, though. I mean, that sounds incredibly risky. They're betting the entire turnaround on a complex, cutting-edge digital financing scheme.
That's the skepticism, and it's totally fair.
Isn't that just adding a huge layer of speculative risk on top of a company already struggling to execute its core business?
That is the #1 bear case right now. And it's why market sentiment is all over the place, the fundamentals, the revenue drop, the dilution, and that's all bearish. But the hype around this RWA plan is scoring very bullishly. It's a tug of war.
And it looks like management is all in on the digital strategy.
Absolutely. The new interim CEO, Marcus Lahn, has made it his #1 focus. This isn't a side project. This is the plan to get the money they need to finish that refinery ramp-up.
So if you boil it all down, what are the top risks for someone looking at Sky Quarry right now?
It's two things, really, and they're tied together. First, continued revenue decline if they can't get that refinery humming. And second, more share dilution if this RWA plan gets delayed or just plain fails.
And on the flip side, what's offsetting those risks?
It's all about that RWA catalyst, the hope that it works, and it works quickly. And they got a huge lifeline from NASDAQ.
The extension.
The extension. They now have until March 2026 to get the share price back over $1. That's a lot of breathing room to execute this plan.
So this is really a catalyst-driven play then. It's all about whether they can pull off this unconventional financing to fix the revenue problem.
That's it. The whole thing hinges on management's ability to launch this RWA platform and get that $100 million in the door. The timeline for that really puts this in a sort of swing trade window, looking out towards early 2026.
And looking at the bigger picture, their whole waste-to-energy tech fits perfectly into that broader ESG theme we're seeing everywhere.
It does. And there's another potential tailwind, if, and it's a big if, but if interest rates start to come down, the cost of borrowing for that CapEx gets a lot cheaper. It just eases the financial pressure all around.
So that's the lowdown on Sky Quarry. It's a fascinating situation where the financial solution, this digital tokenization, is just as innovative as the core technology itself.
Before we go, here's something to think about. If this RWA strategy actually works, if they get that non-dilutive capital, does the market finally start to value this company as a pure play, innovative tech firm? Or will it forever be chained to the price volatility of the oil market?
That's a great question, and the answer will probably determine if the stock is a multi-bagger or just dead money.
Exactly.
That's the question to mull over. If you haven't already, please subscribe so you don't miss our next breakdown. We'll catch you on the next one.